donor advised funds, private foundations, or your real goal is altruistic. Charitable trusts and CLTs can be selfishly motivated with a charitable aspect involved. CLTs are the common use cases you're worried about gifting estate taxes and trying to pass on assets to your kids or future generations while minimizing estate taxes and giving to charity. We'll dive a little bit more into CRTs, which are also known as Charitable Remainder Trusts. This is more of a common vehicle we see. This is one of the go-to best practice strategies for selling appreciated assets. So that's used from everyone from Phil Knight when selling his Nike shares to a lot of folks we're seeing right now sell NVIDIA shares or other appreciated public stocks, crypto, real estate. A Charitable Trust it's very similar to an IRA account of it allows you, it's a tax exempt vehicle. And the practical impact of that is it means you can contribute assets to the CRT, sell them tax-free, reinvest the money pre-tax, and have the money grow pre-tax, and only pay the taxes when you pull the money out. And when you pull the money out, the taxes you're paying are typically long-term capital gains. It doesn't change the income from capital gains to ordinary income. And the real core benefit is that by not paying the taxes today, you get to reinvest the money, and that deferred tax money reinvestment creates more wealth for you over time.
No, I mean, it's super powerful. On a long time horizon, the tax deferral yields pretty significant returns, especially if you're assuming a decent rate of return on your assets, like above, let's say, 6 or 7%. The sort of end of the year hook here is if you're thinking of selling appreciated assets like stocks or crypto in the next 6 months or so, it might make sense to make the transfer in December to offset 2024 income. Because if you wait until 2025, you'll only be able to offset 2025 income. So
Yeah, it's a really great point. Is again, this is a primarily selfish structure, but you do typically receive about 10% of the value that you contribute to the trust as a charitable deduction in the year that you gift the money to the trust. And that money is not given to charity for many years, typically at the end of your life. And just to we were talking about what are the benefits of the structure. We're just jumping into a calculator. This is free on our site. We'll add the link in the chat. But taking a scenario where 40 years old, you live in California, you have an asset that's worth $100,000. Sorry, the cost basis was $100,000 and is now worth $1 million. You're married, you can increase that or lower that depending on if you're more aggressive or conservative with your growth expectations. But what you're going to see is if you set this up just for your lifetime, you can see this is using this vehicle and just deferring the taxes and then reinvesting that money, you can create essentially $2.7 million of additional gains over your lifetime after taxes. And this is really the benefits of tax deferral. And kind of as Peter mentioned, the longer that you do this, the higher the ROI. So I'm just going to change some of these kind of assumptions. So this is for, if you do it for 20 years, the numbers, it's roughly $270,000 versus the longer you do this for, the higher the ROI. And really, again, there's a famous quote of, compounding is it's the 11th wonder of the world. I may be screwing up which wonder of the world it is, but really simple math here is the longer your assets can grow tax-free and the longer you defer paying taxes, the more wealth it's going to create for you. And, this is just one of kind of many capital gains tax planning strategies. I'd say one thing is if you're just exploring this, we also have this tool called the guided planner where if you're not sure really what you're solving for, you can kind of jump into this and just answer a couple of questions of, again, have you realized you're solving for capital gains? Have you realized this? And with kind of picking kind of what type of asset is, you can pretty quickly kind of understand what are some opportunities that you have and understand some of the trade-offs, the benefits that you have with this pretty easily. So everything from if you're looking to understand what are some of these best practice strategies for these appreciated assets and understanding how they work, their benefits, to evaluating the ROI, we make it pretty easy. You can also feel free to chat with us at any time. So we'll just kind of jump into this now. I would say there's a lot of benefits when selling appreciated assets with Charitable Remainder Trust. The ROI tends to be higher the longer you can set the trust up for. And again, the longer you can defer taxes, reinvest it, the more wealth it creates, the higher your tax rate. So if you live in California versus Texas, the more taxes you can defer, the higher the ROI is. And then the other part about this is the better you can reinvest and grow your assets, the more beneficial it is. The big trade-off with the Charitable Remainder Trust is you can only pull out its liquidity. You can only pull out a certain amount of assets each year. So if you need to buy a home in your first year with these proceeds, it may not be a good fit. But if you don't need that money for a while or just need some of that over time, then it's a better fit. One other important piece to call out is if you're selling something, you don't need to put it all inside of the trust. You can put some of it, all of it, part of it. That's really kind of more based on your personal situation.